Good morning, you guys. So we are going to get started on the highly anticipated CalHFA's Dream for All program. I want to go ahead and introduce our panelists today. My name is Brina Hertzler. I've been an account executive with Sierra Pacific for 16 years, and I am joined by my friend and colleague, Chad Shales, who's been with Sierra Pacific for 17 years. And so we really represent the account executives at Sierra Pacific. We are all CalHFA experts, as well as just experts on origination and all things Sierra Pacific. And so we want to welcome you. Your account executives are on the call. And if you have any questions, we do have 1,000 attendees. We've maxed out this Zoom. And so on the next slide, I'm going to show you how you can go ahead and enter your questions in the Q&A because we have disabled the chat. But if something doesn't get answered, reach out to your account executive. They are, like I said, experts on this program, and they'd be happy to help you out. Okay, so before we jump into CalHFA Dream for All, let's talk Sierra Pacific, because some of you have never worked with Sierra Pacific before. Maybe you're just coming to Sierra Pacific for down payment assistance. Some of you have been working with Sierra Pacific more recently in the years and in the past. And some of you are loyalists to Sierra Pacific, and you're not so excited that your secret Sierra Pacific is getting out to the masses. So regardless of where you fall on that spectrum, welcome. We're excited to have you. We're excited for the year ahead. I want to just touch on who Sierra Pacific is. If you're not familiar with us, Sierra Pacific is a veteran lender. We have been in business for over 38 years. We are privately held, and our headquarters are in Folsom, California. And so when I say that Sierra Pacific knows how to do loans, I mean, we have really navigated all the different temperatures of our industry throughout these 38 years. And so because of that, it's allowed us an opportunity to be not only experts, but be able to reinvest in our technology and our processes a few years back. And so in the current market, you'll kind of notice that there's two types of lenders. You'll have lenders that are maybe high tech and maybe a lower personal touch, and you'll have lenders that are a high personal touch and maybe a lower tech, harder to work in. And Sierra Pacific has really modernized our process, and we kind of trailblaze that perfect balance of high tech, easy to use systems with high personal touch. And I cannot tell you enough about the people at Sierra Pacific. Everybody you work with, from the funders to the underwriters to the account managers, these people love mortgage brokers. They love what they do. They know how to hustle. And even when you have a loan in the system, we want you to know how to get a hold of us. And so when you have a loan in the system, all their names, all their emails, everything is going to be in there. You are never lost at who to call. So the support at Sierra Pacific is incredibly high. And so with that, we're going to kick off. Before we do, I just want to show you exactly how you would go ahead and enter the, how you would enter the questions. I'm so sorry. How you would enter the questions into the chat. So right here, Chad, go ahead and show us exactly how they do a Q&A.
Okay, so on the Q&A, guys, on the bottom of your screens, there is a little bubble down there where you can open up on your desktop and type in a question. We do have somebody, one of our expert AEs, managing those questions, and he will jump on this and help out as these questions roll in. Milo is very knowledgeable, and he'll be sharing all his brainiest comments and responses to this CalHFA stuff. Guys, also, if the questions don't get answered during this presentation, do reach out to your account executives. We are the best in the business, and we have the support of CalHFA, as well as our senior staff with regards to a dedicated knowledge group and panel to assist you through CalHFA. There's a bunch of goofy information out there. We intend on being the specialists on it, and we have all the resources to make sure you get the answers. So
yeah, really good to point out, Chad, and even just to know that Sierra Pacific isn't just a CalHFA lender. It's actually a really small part of our business. We excel at CalHFA, but if you think we do CalHFA well, you really want to make sure that you're pricing out us on other loans. Get with your account executive if you're not currently doing that. You really want to keep all eyes on Sierra Pacific. We are the best kept secret, but it is definitely our year to shine. So with that, we are going to jump into CalHFA. Go ahead, take it away, Chad.
All right, guys. So CalHFA, we just want to provide a real brief overview. CalHFA, there is their core group of their standard products. Their standard products are self-funded. It's funded solely based off of refinances and resales of those participants in the program that have originally received either down payment assistance and or closing cost assistance. So the standard products are self-funded. The agency won't run out of money on their standard products. The CalHFA Dream for All product or last year's forgivable equity builder product, those were special products. Okay. And so those special products are initiatives that are put on by the state of California that provides funding to CalHFA in these programs. And so the state of California helps dictate how these monies are to be used. Last year was the equity builder. This year it's the Dream for All. But let's touch a little bit more on CalHFA and really the basics. Okay. So CalHFA is a first lien provider. Whoops, can we go back one screen? I may have touched that.
Yeah, you bet.
Okay. So CalHFA, offers their own first lien, first mortgages. Their rates are put on their website daily. Currently, they're offering Fannie Mae, FHA, VA, USDA. And currently, the bulk of the business that we're seeing is either Fannie Mae or FHA, but these are 30-year fixed mortgages, and all of these 30-year fixed mortgages have the opportunity for down payment assistance and or closing cost assistance. Guys, on these seconds, which is the down payment, and the thirds, which are closing cost assistance under their standard programs, they're not forgivable. They're there for the life of the loan, and they're repaid during a trigger, which would be resale or refinance or a change in title. Okay. And so on the conventional side of things, the conventional conforming, you're getting in with a 3% down payment assistance second. FHA, the down payment assistance second is covering all 3.5%. And then there are zips that we'll show you a little bit later in the program with regards to a 2% zip and a 3% zip that assists with closing costs. We're not seeing too much of those right now because interest rates are high, and also the Dream for All is going to cover all of that. I think that covers just about everything, with the exception that, guys, there is, with the Dream for All, there's all kinds of goofy information out there. Again, the program is funded by the state of California and their budget, and CalHFA does a wonderful job with regards to communicating with the state of California to get funds to create these very innovative programs. They originally sought out $800 million. The budget could only afford $300 million. So this product is hot. And also to why Sierra Pacific is all in on it. We do these things really well. So let's move on.
Let's talk about who really qualifies as a CalHFA borrower. So the things I'm going to tell you here, so there's two programs with CalHFA that Chad touched about. There's their program that they always have, which is the CalHFA My Home. And then, like he said, there's every year program. But the things I'm going to tell you here are actually, which is really nice, applicable to both programs, which is why we're kind of starting with the base of who really is able to apply for CalHFA. And so it's first-time home buyers. That means that every borrower on the loan does have to credit qualify, as well as qualify as a first-time home buyer. And so a first-time home buyer by CalHFA, which is different than the agencies, is defined by a home buyer that has not had any ownership interest in any principal residence. Make sure you notice that principal residence, or resided in the home by a spouse during the previous 3 years. And so this really brings up a lot of questions like, what about this? And what about this? And so the biggest piece is, if you have a spouse that has lived in the property, obviously with their spouse in the last 3 years, regardless if they're on the mortgage or title, they are not qualified as a first-time home buyer. However, in the next two examples, if you have a granddaughter that is living with her grandmother and is on title, she would not be eligible as a first-time home buyer. However, if she was not living with her grandmother and she was just on title, she would be eligible as a first-time home buyer. And additionally, if you have an investor that has not lived in a primary residence for the last 3 years, but they have other properties, they would be qualified as a first-time home buyer. A really big piece for CalHFA is occupancy. Their whole heart of this is sustainability and affordability for first-time home buyers. And so all borrowers must occupy the property. You cannot have a non-borrowing spouse on title or be added after close. They will call that. And so you want to make sure that whoever wants to be on title needs to credit qualify and qualify as a first-time home buyer. Okay, so another question that you get a lot about is, are there sales price limits, and what are the income limits? So income limits are going to vary by obviously county. We're utilizing the Fannie Mae income limits. And if we're doing FHA, we're going to be utilizing those. And so there's no sales price limit, but the first mortgage has to fall under the county loan limits for each of those Fannie Mae or FHA agencies. And then in terms of credit, you've got, on the Dream for All, it's a conventional only product, but on the My Home, it's FHA and conventional primarily. So 640 is the minimum FICO for an FHA. And then when we go to the conventional CalHFA, you're looking at a 680 minimum FICO for standard income. We're going to touch on that. And then 660 for low income. And so when I say low income and standard, initially CalHFA had put out like 150% AMI for the dream. So if you see that on anything, they went away with that. And they're just going with their standard income limits, which we're going to get into. They also allow for low incomes, that affordability piece of their mission for low income. And that's the same as a Home Possible Home Ready, where you're looking it up on the Home Ready lookup tool, and it follows the 80% AMI, area median income. So that's who this program is for. First-time homebuyers do have to do a training required prior to docs. The Dream for All, as you'll note, does have an additional training. And this is important really to protect our name as mortgage brokers, because we want to make sure they understand the program. And so you would do that training typically through eHome America. It's $99. I do recommend getting them started early because it is 8 hours. And then really to protect the homeowner, CalHFA also has a 1-year home warranty that must be included in the closing. And so this is just to protect them from any surprises. Okay, so eligible properties. It is a single family residence, 1 unit. It can have an ADU. We do allow it on condos. They must be Fannie Mae or FHA approved, and we do allow it for manufactured homes. If you have a manufactured home that's trying to do a CalHFA, do reach out to your account executive. There is a little specifics on credit and things like that that you'll want to make sure. Eligible borrowers, U.S. citizens, permanent or qualified non-permanent resident aliens, EAD, including DACA. So CalHFA, you'll hear us talk a lot about that. What you know about Fannie Mae is going to be the same for CalHFA, and what you know about FHA is going to be the same. There's one piece where they really do have some overlays, and it's this piece. When you're working with a borrower that's got a Visa or an EAD card, you really do want to check with your account executive to make sure that they qualify that. Chad, before we go to the next one, do you have anything to add to this?
Actually, guys, I do. So let's talk about credit a little bit. We've seen all over, television, Experian Boost, to boost FICO scores. CalHFA does not allow for the boosted type trades, the self-reporting, rents or cell phone type trade lines, non-traditional credit being added to the credit report. CalHFA wants a clear representation of the credit report. So guys, if you do happen to pull credit and see anybody that's got these self-reported trades on their credit, they're going to need to have those removed, disenroll or unenroll from their boost program, and then pull a new credit. That new credit is something that has to be imported into our AUS system, and also has to be shared with CalHFA. So it's really important to make sure you take a look at those credit reports, make sure that the boost stuff is removed.
Also to note on here is the DU approval, which I skipped over. So Sierra underwrites, like I said, to the FHA and Fannie Mae guides, and we do need a DU approval. The really great thing is in the olden days, there was all these different CalHFA, must have 3 years tax returns, must follow household income, must have 2 years DU. And so we will really follow the AUS findings. We do require 2 years, but if the AUS gives you a 1-year finding for your self-employment borrowers, we will allow that. And you do want to follow this DTI here, where it's a 50% max if your borrower has a 700 FICO or plus. If they are under that 700 and they have that 680 or 640, they are tethered to a 45 DTI. There is a hard stop at that, no exceptions. And you do really want to be reading your AUS findings, because there's a lot of information. So you may get, oh my gosh, I thought this borrower was totally going to get an AUS approval. And you're like, oh man. And so you really want to make sure that you're reading the AUS, because Fannie Mae and FHA, even more recently, have been pushing little risk factors into their AUS that they didn't actually tell anybody about. And so last May, one of them was first-time home buyers. And all of a sudden, it was really hard to get a borrower approved with CalHFA unless they had a really high 700 FICO. Recently, I've seen them allow a little bit lower with the Dream for All when you're putting a lot of money down, but just make sure you read that. Another piece that Chad's really passionate about is the fact that they've snuck in these reserve requirements that's not published anywhere. And so if you see an ineligible or refer, make sure you're looking at that first section that tells you why that you didn't get the approval, because often you can fix it, or you look at the very bottom and look at what's the cash to close, what's available, what are the reserves, and what's available, because sometimes you are getting an ineligible just because of this. So it doesn't mean it's game over. Just make sure that you read your findings. Chad, go ahead and touch on that a little bit.
Yeah, so typically on the reserves, guys, it'll say on that second to last page of the DU findings, 1 to 2 months reserves, 1 or 2 months. And so guys, when you're structuring these transactions, and especially in the Dream for All component, if your applicants have money, keep the money, validate the money, verify the money, and use that asset as a reserve. Utilize the Dream for All proceeds to cover the closing costs and the down payment. The reserves are a crucial component to the DU findings. And then additionally on the DU, and I just had one this morning, the DU approvals are really, it's my favorite underwriting engine out there. So they're very accurate. They'll tell you what might change that frown from upside down to upside right. There was, and this is one of the things that Brina pointed out to me last fall. So in one of the paragraphs, the DU, it was refer eligible, and DU mentioned, hey, if you go through it and you utilize the verification of asset link, which is a day one certainty tool that's located in our system, you just click the button, making sure that you've got the right email address and account information, whatnot in our system. But you click the button, and what DU is asking you to do is take a look at your applicant's bank statements for the last 12 months to see what they've paid out on time for rents. So it's an online verification of rent for the last 12 months. And if your applicant has been paying, through their bank account, 12 months paid as agreed on their rents, then that will pull into the DU, you rerun the DU, and it could turn that into approve eligible. Guys, paying cash for rent or Zelling it, that kind of stuff, that those things pretty much won't work. But if they're paying them directly out of their account and it clearly delineates that it is, a rent payment, then that's another tool that's at your fingertips. That's a simple click to go through and again, get it approve eligible.
Yeah. And it's kind of like they're saying, you're almost there. If you can verify those rents, we'll give it to you. And really 10 times out of 10, if you can verify those rents online, they will give it to you. And again, this is something that's not really out there, but if you see that VOA, that's what it's asking about, reach out to your account executive.
And it is online only, guys. We can't take, a VOR and force it into DU anyway. It has to be through that verification of asset link or their day one certainty link that's found in Express Loan on our site.
To be digital. Yeah.
Yeah.
All right, let's do my home, Chad.
Okay, so again, just continuing on a little bit with the standard programs with CalHFA, and guys, this is all going to wrap together really easily here in the coming pages when we bring Dream for All in. But my home, again, it is, for CalHFA, this is a universal thing for all programs, whether it's standard or their specialty products like the Dream for All. There are income limits, and we have a chart here. And if you can, take a look at the counties that you prospectively, work in, this is their standard income chart. This is a tool for you guys to save on your desktop, and you can look at, look, in El Dorado County, California, the standard income limit is $202,000. The qualifying income has to be equal to or less than that limit. And guys, there's a few tricks that we know here at Sierra Pacific that we've worked with CalHFA on. This is really kind of cool. So the applicant, let's say you have a scenario and you've got an applicant that has 200 grand worth of income for El Dorado County, and you see on their pay stub, they've received bonus income of $50,000 a year. And so now they've exceeded that $202,000 limit. Guys, CalHFA accepts, Fannie Mae accepts, and we will underwrite to the income that is input into the loan application. So if you write down, or if your applicant signs a 1003 and says, we're using my base wage at $200,000 a year, and we see all your income tax and it shows $250,000, $260,000, $300,000 a year, but you put down the base wage and the base wage qualifies, guess what? We're underwriting solely to that base wage. We're not even
really, because CalHFA uses qualifying income. So when I touched on that household income, USDA is the only program ending in your lending portfolio that you actually have to follow that household. This is qualified income. So if you can qualify that income, like Chad said, at salary or base for their base, then you do not actually, even if our underwriter sees that on the pay stub, you're qualifying at their income. And so go ahead and touch on how you can utilize that for reducing their income if you're trying to get to low income.
Same thing. And I did this last year many times with the Equity Builder program for the low income applicants. So in Sacramento County, which this was pretty much, these couple of scenarios that I'm talking about, the low income, the 80% AMI Fannie Mae income for Sacramento was like $82,000 a year. And again, looking at an applicant's pay stub, the home that they were seeking to buy, their base wage qualified them for their purchase. But when you looked at their pay stub, oh my gosh, their income is above that low income derivative of, I think it's what, 81,920, I think for Sacramento.
Yeah.
Coach that MLO. Listen, guys, you don't have to drive down the income. You just have to use the base income. Don't put on, bonus tip, commission, overtime income. We're going to ignore that. We'll see it, but we're going to ignore it. And we're not going to underwrite to it. We're not going to get an issue to it. We're solely going to use that base wage. And the benefits, guys, on the low income stuff is a couple of things. One, you're receiving HFA preferred lower mortgage insurance on your conventional transactions. You're also getting a better interest rate, which we'll dump into here in just a minute. And then on the Dream for All, the shared appreciation component reduces by 25%. And we'll touch on that again here in a second. So again, from income, CalHFA has a universal need we've talked about a few of their overlays: FICO scores, debt to income ratio, and income. And so sharing some of these tricks and tools for you is going to make you a little bit more astute and professional with regards to your applicants and to those who aren't receiving this training. On the My Home, guys, we're typically seeing My Home today with an FHA first and using seller concessions. There's also their ZIP programs. CalHFA, when we were really first dedicating our hearts and souls to CalHFA, interest rates were really low. And so the CalHFA first with the ZIP second, like a 3% second to cover closing costs. It's 3% of the loan amount or 2% of the loan amount.
Yeah.
Those interest rates and programs were really, really favorable back then. But in our environment with interest rates that have crept up, those are really not very affordable and not the best use of your applicant's money and qualifying ratios. So we're going to keep touching on the Dream for All here to show you how to not use ZIP today, but tomorrow when it becomes relevant, we'll teach you that too.
Yeah. And a common question you get is, are these loans forgivable like last year's?
So last year's forgivable equity program that had a 5-year schedule for forgiving 100% of the assistance, the 10% assistance last year. Guys, all CalHFA programs today, including the Dream for All, they're not forgivable. Okay. So we talked about a couple triggers: title change, resale, and refinance. And any of those occasions, CalHFA wants to recoup the down payment assistance and closing cost monies that they have provided your applicant. And the idea about recouping them is, again, CalHFA is a self-funded entity. They want to keep bringing back funds so that they can help fund the next transaction for your next first-time home buyer. And so none of these programs are forgivable. Your account executives can help walk you through, how or the circumstances or specific scenarios that you have. But just do know that CalHFA wants to recapture, that assistance so that they can continue to be innovative like they are and provide new hot products that are relevant to our first-time home buyers. And guys, we get this question a bunch. Can additional funds be brought in on a CalHFA transaction? The answer is yes. So everything you know about a Fannie Mae loan, everything you know about an FHA loan applies in CalHFA as well, with only those few overlays that we've talked about with FICO scores, DTI, income limits, and first-time home buyer requirements. Any Fannie Mae eligible source of funds may be used for down payment. Any Fannie Mae eligible source of funds may be used for closing costs. Any FHA eligible source of funds may be used for down payment, and any FHA eligible source may be used for closing costs. So guys, your applicants who do have seller concessions or gift monies, they can buy down their first mortgage, or structure the loan so you're increasing the down payment to make it more affordable. Or they can utilize seller concessions to pay closing costs to then use all of the 20% on the Dream for All to avoid minimal mortgage insurance on their program. So yes, you can bring in additional funds to close. It's everything in terms of documentation wise, everything you know about Fannie Mae, everything you know about FHA. It's really that simple.
Yep. Well, I have the pleasure of kicking off I have the pleasure of kicking off the Dream for All, which for some reason my slide is not moving over. Nope. Oh, it's just jumping all over the place. Okay. So Dream for All, probably the reason that most of you are here today is to talk about the Dream for All. And so the reason that we laid that foundation for you is, as you can see, it's same FICO, same income limits, same DTI and first-time homebuyer requirements. Just as a recap, this is a conventional only program. So your FICO would be 680 for a standard income. And let's pause right there. Once again, you have two types of borrowers: standard income and low income borrowers. Standard income limits have nothing to do with AMI. They are just CalHFA's income limits that they allow for all of their first-time homebuyers. And then they have this other low income borrower that follows that 80% AMI. And so for the low income, it's still 660. And for the standard income, it's going to be 680. So what is Dream for All? So Dream for All is an up to 20% second lien of the sales price or appraised value, obviously whichever is less. And this can be combined for both down payment assistance and or closing costs. And so we're going to talk about some of the ways that you would structure that, but that is one place that Dream for All really differentiates itself from My Home, because My Home, the previous program we just talked about, is only for down payment. And so you can do a whole bunch of combinations. So let's talk about the minimum CLTV is 70% and max is 105. And so just to touch on that question, I'm sure it's there in the chat. Milo's working away at that. Can borrowers bring in their own money, and what's the max? So if you have a borrower that has their own money, they can bring up to 30% of their own money in combination with the CalHFA second Dream for All. And so this allows them to be at that 70% and then going up to a 105. And so your 105 folks are probably where you're structuring it for a borrower who either doesn't want to put their money into the transaction, they don't have the money to put into the transaction. And so the way that you would structure that in the situation, again, no sales, there's no sales limits on this. It's just the first that's going to follow your county loan limits. And so your first is going to be at your county loan limit up to that max. Your second is going to be up to 20%. So you've got essentially 20% to work with. And so the big question that you really need to consider when you are trying to figure out down payment assistance with CalHFA is who's going to pay for the closing costs, because these are borrower paid loans. So you've got your compensation, which you're going to see on a slide. You are allowed to make 2.25, or your lender paid comp, whichever is less. And so let's say, for example, that your lender paid comp is 2% and your closing costs are 2.5%. That total closing cost for that borrower paid loan is now 4.5%. That's what you have to figure out on a borrower paid loan, on a down payment assistance with CalHFA. Who's going to cover that? And so you've got a couple different options. If you got a seller concession, then you can apply that seller concession to those closing costs. One thing to note is that when you are doing the My Home, your seller concessions at that high LTV with Fannie Mae are only 3%. When you do a Dream for All, your LTV is often much lower. So if it's under 90%, then you can do a 6% seller concession with Fannie Mae, which matches FHA. Go ahead, what?
The CLTV has to be equal to or less than 90% as well.
Correct. Yes. And so you would be able to match that 6% with FHA on that. And so you've got that option. If you can have somebody cover the borrower, a gift from one of those sources that is allowed with Fannie Mae, or seller concession, if they can cover that 4.5%, your full 20% with CalHFA Dream for All can go towards down. We know what that's going to do to the payment. It's going to do something to the payment. It's also going to reduce the need for MI, which is a huge piece in payments, mortgage payments these days. And so the borrower is not only able to have the purchase power in getting into contract, they're able to get more home than they would have without this program, but they also have the option to eliminate that MI and allow them a much lower payment overall. Here you can see also it's the same income limit. So we included that chart again. There is one caveat with CalHFA, and that is that while they give you the 20% interest-free, payment-free, they do want a cut of the shared equity. And so what that is you have your 20%, and then of that 20%, whatever you borrow on that second. So if you borrow 10%, you would also give CalHFA a 10% shared equity. If you borrow the 20%, which I think most borrowers would do, they're going to give CalHFA a shared equity of that 20%. And so we're going to go through an example of exactly what that would look like, but you would basically at the time of paying off that second, so your borrower writes mortgage payments for 30 years, that is going to be what qualifies them for that second is due payable. At the time when you pay off that second, that's what triggers the shared equity piece. And so it's going to be really important that borrowers stay close to their originators, not just with this purchase, but also when are we going to refinance the home into a possible better rate and pay that second off? Because you also have to consider when you pay that second off, that's triggering the shared equity piece. And so you really want to coach borrowers not to really hold on to that second for 30 years, because that's a huge amount of appreciation. If you look over at the 70-year of appreciation in California homeowners, it's a lot of appreciation. So you want to coach them on not just holding on to that. The one thing that CalHFA did really great for this program, and I really am pleased with it, because I think that home buyers right now, specifically first-time home buyers, are concerned with two things. They are concerned with not only the rates going down, but home values going down. And so that one-time refinance that CalHFA put into this program that don't allow in their other programs really assures your borrower that they can get a lower rate and not have to pay off that second one time should the rates go down. Another common question that we get is, so what happens if the home doesn't appreciate? And the answer is you're going to share with CalHFA whatever percentage it did appreciate. So if it appreciated nothing, zero, you would share 20% of zero, which is zero. Another question I get often is, what if the home depreciates? If the home depreciates, it's just like anything. You're going to continue writing the mortgage payments, and it doesn't matter whether it's stocks or the equity in your home. It only really matters when you sell the home or refinance what the equity is. And so if your home depreciates and you're not refinancing or selling, business as usual. If you were going to sell the home, you had to move into a different state and sell the home, and the home had depreciated and your borrower could not cover back the first and second mortgage, your borrower would be in a situation where they would have to do a short sale. Chad, do you want to add anything else to that before we move on?
Yeah, absolutely. So another question is, what about the homeowners that buy today? They do a bunch of improvements, throughout the property, and then tomorrow they want to refinance or sell. And there's a lot of bunk information out there, guys, with regards to, you can net all of your expenses that you did on your remodel and renovation products and your landscaping and all that stuff. You can net that out of your appreciation. That is bad information, guys. It makes sense that CalHFA doesn't allow that because not all home improvements would improve the value of the property, right? I mean, what if somebody went through and carpeted the walls, the floors, and ceilings, and then put 3 different shades of Mary Kay pink on the outside of the house, and they spent $100,000 doing that? Would that be a viable explanation for netting down the shared appreciation? Because not all home improvements will do a dollar for dollar improvement to the property. So the improvements are taken into consideration, at the time of a trigger. So if they're going to refinance, sell, or there's a title change, there's going to be an appraisal done or an AVM by CalHFA that will determine the value, that will then determine the appreciation that is earned on the property, and then from there do the calculations thereafter for the shared appreciation component. So guys, the bad information is, no, you can't net out expenses for remodeling or renovation. It just isn't built that way. The safe way to do it is valuation at time of a trigger. Okay. And
and you're going to see on the next slide that it really comes from sales price to sales price. If you're selling it, CalHFA is going to look at this. I asked them today, well, what if there wasn't, on a refinance, you'd obviously use the sales price at purchase with the appraised value on the refinance. But if you're selling the home and you couldn't get a hold of the appraisal, how would you use? And they would use an AVM or the sales price for that purchase. So let's go ahead and go to the example of what that looks like visually here.
Yeah, so guys, on this particular example, this is for a CalHFA standard income applicant, and on a standard income applicant transaction, let's assume 20% was utilized for down payment and closing costs in terms of the Dream for All program. And on the standard income shared appreciation applicants, their responsibility, again, at time of a trigger, which is refinance, sale, or title change, is to share appreciation in the 20% bucket. So in this particular case, we have a home that was purchased for $500,000. They received $100,000 for that 20% down payment assistance second, the down payment and closing costs. And let's move forward. We're going to advance 5 years and they're going to sell the house. Okay. Let's see, property value is at 640. And so you have an appreciation of about $140,000 in that case. CalHFA wants 20% of that $140,000, which is $28,000. And just for your first time home buyer making the payments on time and taking care of their house and taking care of their pride and joy, they earned $112,000 of appreciation. And that's what essentially they're going to net on that transaction. And that's what these two buckets talk about here. Right. Guys, it's not a painful thing. It can be painful in terms of the shared appreciation component. If you let it ride for 30 years and 30 years down the road, the house is worth $1 million, $2 million, $3 million on this example, then your applicant is going to be paying back the $100,000 plus about $250 in shared appreciation. CalHFA kind of put kind of like a window, a suggested window to refinance out of this program between years 3 and 5, because as you see, with this particular paying down of the mortgage, the natural amortization of the loan, they are paying down the mortgage. And so their net gain is actually a little bit higher than just the shared appreciation component to it. So it is a good idea to pay attention to your pipeline and to your clients, that you put them in these loans for two reasons. One, we're going to allow you to do, or CalHFA is going to allow you to do a one-time refinance to better their payment while they're still living in the property. And then two, in those years 3 through 5 or 7, you're going to want to reach out to them as well and say, hey, listen, how you doing? House property value looks great. Let's get you out of the shared appreciation loan and get you into something where you're not going to have to give back more of your appreciation down the road.
Yeah, and that cap is really, I mean, to get to that cap, because just in this example here, if your second is 100,000, that cap is 2.5% of that 100,000. So that'd be 250,000 as a cap. That'd be the 20%. So you would have to have like a million, like so much equity to reach that cap.
It was $1 million, $2 million, $3 million.
Yeah, it's really you're not gonna get to it. But again, don't let them write that. Don't let them just keep that second on forever. And then the biggest issue, or the biggest change you'll see in the next slide, which is for low income, is in green, where that 20% changes to 15%, still speaking to CalHFA's heart for affordability for home buyers. Is there anything you want to add here on this, Chad?
Sure, absolutely. So the net, for the low income applicants, guys, and again, sometimes it makes sense to make sure that you are offering this program or driving down the income if they qualify, because the shared appreciation guy, it reduces by 25% or 15% is what the shared appreciation component is. And so their net, is greater because their payoff to, of the shared equity component is less. The other thing that I wanted to share with you guys, and when you're communicating with your buyers and they see this shared appreciation component, it might feel a little bit scary. Okay. It's not. Okay. It really isn't. Your homeowners are getting down payment assistance and closing cost assistance to the tune of 20% of the purchase price. All they have to do is make their payments on time, and they're earning this. Okay. It's fantastic. And then the other component to this, which is a great sales point, CalHFA is incredibly innovative. They're relevant. They're viable. They've introduced, all kinds of new technologies to streamline their processes, and they have an intent to be here tomorrow to continue to offer this product for first-time homebuyers in the state of California. And so, recapturing the 20% down payment assistance and recapturing some of the shared equity, guys, this is designed for tomorrow. Okay. Yes, there's a limited budget of $300 million today, but the idea is tomorrow, when these things start turning and cycling, it's to self-fund a program like this or exactly like this. Okay. And so CalHFA is really devout on making the program independent of budgetary offerings. Okay. And so their specialty programs, $80 million last year for the Equity Builder program, $300 million, this year for the Dream for All. The idea is to have them be autonomous and then also have special offerings as well. So this is a win-win-win for everybody. It really is.
Yeah. All right. So we put here the daily rates for today. And so I kind of want to just go over these really quickly. I'm going to kind of annotate which one I'm actually looking at here. So basically, when I'm looking at this rate right here, there's a special thing where you've got no CalHFA DPA. These are the conventional rates here. And then below those, you'll see the government rates. When we talked about CalHFA's original down payment that doesn't have specific funding for it, like the $300 million for the Dream for All, this is the rate that you're looking at right here. And you can see on the conventional rates, you have both standard rate locks as well as low income. But when you move to the government rates, you only have a normal standard rate lock. And so when you're looking at the conventional and you're doing a My Home, which is the 97% first with the 3% second, borrower paid, and your borrower has to come in with that 4.5% of total closing costs like we discussed, and you're figuring out how to structure who is going to pay for those closing costs. This is what we were talking about, is this is going to be your first and second for My Home, 6.375. This would be the low income rate. This is the one where Chad said that you have a much lower, like an 18% MI coverage versus a 35% MI coverage following your AUS. But here is where we said that typically you're not going to want to add these additional zips for 7.5% just to get 2% in closing costs, and an eighth for 3% in closing costs. You truly want to get a gift or something for that closing costs. And then here you can see what the low income rates are. Right here you can see highlighted in orange what the Dream for All rate is. I mean, I think a lot of us on Monday when we went to that CalHFA rate sheet to see what is the rate going to be at, We're shocked to find that your borrower is going to be able to do a first and second. On the second, no interest, no payments. They only have to pay the first, and the rate is going to be 6.375. So that is incredible. Moving on to FHA, which, just as a reminder, this is only for the My Home. FHA, you'll notice, doesn't have that special with DPA or no DPA. This CalHFA FHA rate you see here is for the first and second. The rate is 6 1/8. And so when the money runs out for the Dream for All, and you guys, the money will run out eventually. And so you want to be talking to your clients. We're going to talk about how you reserve those funds. There's a lot of different opinions on that. They are just opinions. Their facts are that you're going to lock it, which Chad's going to go into here soon. But here's the FHA rate. Here's if you added those additional 2% for closing costs and 3%. So anytime you see an NA, when I first saw this, I asked CalHFA, what's up with the NA? Basically, the rate is too high. They don't think it's affordability for homeowners, and they just leave it off the rate sheet. And so here you see VA, USDA. We don't do a ton of these, but we do offer it. When we talk about doing a My Home versus a Dream for All, I've told you that the second on the Dream for All has 0% interest. My Home does have a 1% simple interest that is accruing in the background, and then you would pay that back, obviously, at time of paying off the second. There is one little trick that I want to show you guys. So see this right here. This actually does not mandate that your borrower is a first-time home buyer. And so all of a sudden, because of the agency LLPAs, known as the loan level price adjustments, the pieces that the agencies have put into pricing that bump those rates up super high, CalHFA does not have LLPAs, no loan level price adjustments. The only thing that they charge for is a pricing hit for high balance loans. And so a lot of originators have gotten kind of savvy with the fact that if they went to price out a borrower that even was a first-time home buyer that did not meet the Fannie Mae, Freddie Mac waiving of the LLPAs because their income was over the 100% AMI or 120 for those non-CalHFA, just straight agency, they've realized that they can get a borrower into a CalHFA with a much lower rate than you could just going straight Fannie Freddie. The one thing to note is that that's always still for first-time home buyers, and it's always still borrower paid, except for this rate right here. You don't have to be a first-time home buyer. However, it is still borrower paid. So you can kind of do the math and play with that as you will, but that is a huge pricing hack that I want to make sure that you're aware of. It would follow all the same FHAs. Chad, before we move to the next one, do you have anything you want to chat on this about?
I've got a question for you, Brina. So looking at the rates that are posted here, on today's daily rate sheets, does CalHFA have any different rates if the property type is different, like a manufactured home or a condo?
No, there's no LLPAs for CalHFA rates. And so you'll notice there's no discounts, there's no credits, there's no LLPAs. And so again, if you have a borrower that has a high LTV, maybe a lower FICO, and you look at your normal pricing and there's a ton of LLPAs on there, and your lender paid pricing even is into the high 7s, mid 7s, in general, you may want to consider taking those borrowers borrower paid. But you also want to consider that you actually might be able to get them a lower rate doing down payment assistance, even if they didn't inquire with their originator about down payment assistance. Yeah, so it's a good point. Yeah.
Just another trick to the trade.
Yeah, we're full of them, guys. Contact your local account executive. All right.
All right, next slide, please.
Yeah, so I have to basically undo this, and let's go ahead and erase. And we can move on. Oops, it's giving me all these little fun things here. So we're going to undo this, clear, and hopefully it'll move. Oh, I knew I shouldn't have maybe used that little funny tool there. So we're going to undo these. Hopefully it'll let me out of here. Go ahead and do this and see if it moves to the next one. There we go. All right. Why Sierra Pacific, Chad?
Okay, guys. So just again, friendly recap. On all CalHFA loans, you have the standard Fannie Mae and FHA stuff. I just want to recap real quick to bundle this up, and then we'll talk about Sierra Pacific. Everything you know about Fannie Mae applies. Everything you know about FHA applies. Really, guys, it's that simple. CalHFA has a few requirements or overlays. FICO score, 660, 680 and up. DTI, as it correlates to your FICO scores, 699 and less has a 45 cap, 700 up has a 700 cap, a 50 back end cap, excuse me. And then there's the income limits. There's the low income limit and the standard income limit in a first time home buyer education. courses that are required. I don't think that we touched on the secondary shared appreciation education course too much for the Dream for All program, guys. Do get your applicants involved with their homebuyer education as early as possible in the process, or if you know that you're going to be using the program for them, their certificates, their education is a mandated requirement prior to submitting the loan over to CalHFA for their final review and commitment. And then also too, as part of the 2 courses that they do, the first course, which is their traditional first-time homebuyer course, they have the secondary Dream for All Shared Appreciation course. This is designed to teach them what the shared appreciation component to the transaction is about and what it means and how it works.
Yeah.
The third component to their education is that they must have a counseling call with a CalHFA counselor. Those spaces and times and slots are limited. And if that counseling call is not complete, your applicant, your buyers are not going to get their certificates, to which then we have to sit and wait before we submit that file over to CalHFA for their final commitment and review. So get them started now. Their certificate, their completion of all this is good for 12 months. So get them done, get it, so you're not going to delay your transactions, because that will be a stopgap down the road. Last year, when Equity Builder was wrapping up, there were delays of 2 and 3 weeks that we experienced because the counselors were all booked out. There's nothing.
And that's actually already happening again with the Dream for All. So definitely just,
so super important, guys. So super important. So again, Fannie Mae, FHA loans, those few overlays. Okay. Now let's talk about loan processing and how it works with Sierra Pacific. Sierra Pacific has really done a fantastic job listening to you, listening to us account executives, in developing a team that is incredibly smart with regards to CalHFA and just all things CalHFA, you guys. So our submission process, contact your account executive. We've got some video links that will teach you how to input the data points into our system so that the DU knows that you're running a CalHFA with down payment assistance attached to either a Fannie or an FHA loan. It's real important that your data input is accurate for the findings to be accurate, because we would hate for you to just to plumb in a gift as an asset, which is wrong. That's going to give you different findings than if you have the bond and the down payment assistance. I've seen transactions come in with a gift, then we correct it and then not work. Okay, so if you have questions with regards to data input into Express Loan, contact your account executives. They're very intelligent with this, and they'll help you put that together and also structure your deals. So now Sierra Pacific, our dedicated team, we've got set up people that do disclosures, all the disclosures. Sierra Pacific does all of them from initial LE to final CD. Our doctors, our funders, our underwriters, they're all experts on CalHFA. It's a one loan submission. There's no extra documents. There's no extra spreadsheets or, Pythagorean theorem calculations that you have to do. It's simply the data input that you put in the Sierra Pacific and submitting it over.
Sierra Pacific. I really want to touch on this first one right here. Only one loan required for submission. A lot of you guys talk about so I have to put in 3 different loans and create 3 different loan numbers. That is the old way of doing business in general. And just to know, even when you're doing a non-CalHFA, like a first and second HELOC combo, we follow the same way that we do loans, which is to make it easier. So even if you were doing a non-CalHFA first and second combo, like you're doing a second through Symmetry, you don't actually have to send the loan to Sierra and Symmetry. Sierra Pacific handles that whole thing under our transaction. That's the same philosophy that we do our CalHFA with. It's just one submission. We handle the whole thing with CalHFA. You don't have to get involved, and we coordinate all that for you. And then also to know, as we're issuing these initial disclosures, typically on a CalHFA, you will get basically a note from our team before issuing the LE to say, hey, are we good to go? I do want to note, the amount of volume that we're getting right now, we're just getting the LEs out because we need to be able to move your transaction through. And so you won't get that initial LE. You do have a team that if there is anything that you need to talk about, you can, but just know, typically you're going to get a heads up on that LE before we send it out, just like you will definitely get a notice of the CD before it goes out to confirm that everything is balanced, because that's really where we balance it all out. You will be notified, but just as you know, on the LE, we're just kind of getting them going right now.
Yeah. So guys, another thing that's really important, you're working with Sierra Pacific Mortgage. So aside from our expertise on our standard products, we have done a really great job with training and cross-training our underwriters. Guys, we're delegated for the CalHFA product, and so we know what we're doing. And with that, the processes for completing the CalHFA transaction are just like what the first line says, only one loan submission required to Sierra Pacific. It's just like a normal loan to us with the CalHFA product code. And so that loan will go through our system. You'll get conditionally approved. We'll get your prior to doc conditions. We'll get the first time home buyer education certificate. And once we're essentially at a clear to close status, our team will then send the file over to CalHFA for their review. Their processes, they love Sierra Pacific Loans first and foremost, because we've done a really good job at streamlining it. Oh, did we forget to mention, Brina, that we're the #1 TPO lender in the state of California?
I couldn't hear you. What'd you say, Chad?
We're the #1 lender for CalHFA with regards to CalHFA transactions and submissions. So CalHFA loves to see our stuff come through. They use their AI just to check the trigger points. So they're not re-underwriting the file. They're not going back and looking at how we calculated income, but they're looking at a few triggers, right? To make sure that the loan that we're submitting to them fits the program that we have selected or that you have selected. So they're looking at DTI, they're looking at FICO score, they're looking at first time home buyer education, they're looking at income, and they're looking at do you approve eligible findings. I mean, it's really that simple, okay?
Right.
And so those processes with them, they're going to elongate because volume is really coming in by the truckload right now. But typically they're jumping on our stuff in 24 to 48 hours. That will probably change a little bit, but it's really pretty quick, okay?
How long do you anticipate these, like people needing to get in close of escrows? Because I know that typically we can close, I think we've done these in 11 to 12 days on a CalHFA, and I'd say typically 21 days or less. But what do you anticipate people should get in terms of their escrows and things like that?
Well, of course, actually, that's a great question, Rena, because it tag teams two different things. So the Dream for All program, guys, is a Fannie Mae conventional loan. So your pre-approval letters are Fannie Mae conventional loan. Okay. And so that should help your realtors be a little bit more comfortable with the transaction. And then number two, we have to plan accordingly, right? So your data in and your documents in, the more accurate you are and the more complete you are with your submission, then the less underwriting touches that you're going to have on process. We do intend on turning and burning these files. We are prepared as best as we can with regards to the low volume that's coming in. Typically, our turn times are about 2 business days. We do expect them to, in all departments, we do expect them to elongate a little bit, because again, we're getting this huge beach ball of volume. Once that floodgate opened up on Monday, submissions have come pouring in. I think 30 days is probably still doable. The lock process, which we're going to talk about here in a minute, locks are 30 days, but extensions are available. So
yeah, kick us off on that.
Yeah. I don't want to, scare anybody that it's going to be a 30-day process. But guys, things that can hold it up are things that might be out of our control, which would be CalHFA's turn times, as well as the home counselor, call, that component to things. I think from
a conservative standpoint, getting into a 45-day escrow and then being the hero when you close early is a really conservative, wise move. Some of you aren't going to be in that position, and you're going to be kind of risking it a little bit because we don't really know the wave that's going to come in for both Sierra Pacific as well as CalHFA. And so I would say if you're a conservative person that wants to sleep at night, do it a 45-day escrow. And then if you do close it in 21 days, you're a hero versus having to continue extending. But like Chad said, the locks are for 30 days. Tell us how somebody would reserve funds, Chad.
So guys, Sierra Pacific, again, leader in this product, leader in the state of California. We've manipulated our program a little bit to benefit you. Okay, so here's your competitive advantage with utilizing Sierra Pacific over other lenders.
This is huge. I don't know any other lenders doing this on how to get a hold of that. Yeah.
It's typical that another lender will require full underwriting approval before you're able to lock. Sierra Pacific, okay, this is your competitive advantage. Sierra Pacific will allow you to lock and reserve the Dream for All funds with simply creating a loan in our system, import your 1003 or your BSBO, your credit, run the AUS, get approved eligible findings, and then make sure that your DTI and your FICO score fits the program. Okay, if all those parameters in there and you've got the product, code selected within our site, and again, our account executives will walk you through that process. Just those things there will then allow you to lock and reserve the funds.
Yeah, guys, so in contract with an AUS approval meeting guidelines, ready to roll.
So you have to have a property. So thanks for mentioning it, Brina. You can't lock or reserve funds without having a property. That's also
in
bad
contract.
information. Yep. Yeah. You have to be in contract. So in contract means, you're committed to this loan. So before the initial disclosures are even issued, you get to lock and reserve the funds with Sierra Pacific. Guys, the lock process is for all of the technology that we've introduced into this whole world of lending. Guys, the process with CalHFA and secondary with them for locking and funds reservations for that Dream for All program, it's a manual process. And so
Just say it, Chad. Is it a form?
it's a form. You have to, it's a form. So we have a lock request form and funds reservation form that your account manager and and account executive will send out to you. So that form has to be completed and emailed back to your account manager at Sierra Pacific by 1:30 p.m. daily, Monday through Friday. The lock shut off over at CalHFA is hard at 3 p.m. daily. So we need time, they need time in order to process the lock and reserve your funds. So if it's a lock request that we receive at 1:31 p.m., guys, we're going to have to force you to the next day. We work and follow CalHFA. We work together with them. So we want to make sure that we're not, creating additional stresses, on both ends. Hopefully
What if something happens and I need a few more days on this lock?
Oh, beautiful. Great question. So guys, CalHFA does have extensions available. That 45-day escrow that you mentioned, Brina, a standard lock has no cost unless you're doing a high balance transaction. An additional 15 days with CalHFA is very affordable. It's a quarter in fee, 25 basis points. Okay. And yes,
Can I just do 15 days, 15 days, 15 days?
You actually could do cumulatively
Up to 30 days.
Yeah, exactly. So, and then there's even longer lock extensions available, but please guys, we're not looking to do that. CalHFA doesn't really want us doing that, but work with the account executive if you need more than just the 15 or 30 days on the lock extension. Okay?
Yeah, and if you get to a position where you only need like 1 or 2 days, reach out to your AE. They probably can pull some magic for you. And additionally, if you have like new construction, reach out to your account executive because you can usually do a little bit longer extensions, typically up to 60 days for new construction. And so that is something available. There's a lot of trending going around with 2-1 buy downs. And so a lot of common questions that we get is, hey, is CalHFA going to offer a 2-1 buy down? To be truthful, CalHFA does allow a 2-1 buy down, but I don't know any lenders, including Sierra Pacific, that allow it. And I think that when we really kind of pencil out the math, permanent buy downs, which is something that we do allow in CalHFA, is really beneficial to the client. And so the way that you would find out about what's the permanent buy down for this rate, it's going to follow your exact borrower and it stays with the borrower. And so you can request that from your account manager the day that you're locking. You can request it if you've locked and now you've come into a little bit extra money in the transaction and you want to apply that. And so just as a reminder, buy downs are lender paid or seller paid, and CalHFA is a borrower paid loan. And so you can only do a seller paid buy down even on permanent. And so you do have to apply it that way. And then you can be able to do a permanent buy down, but this does allow a huge advantage for these basically for these loans. And then in terms of fees, Chad, go ahead and break down those fees for us real quick. Before
so CalHFA has some fees and Sierra Pacific has our underwriting fees. Guys, these are pretty much standard across the board with CalHFA and Sierra Pacific's admin fee. There's no additional real surcharges on these transactions. And yes, these fees right here that you see, including your compensation, are all covered with the Dream for All down payment assistance and closing cost assistance program.
if you choose,
or paid for by any Fannie Mae eligible source of funds or any FHA eligible source of funds. Okay. And then we do allow for broker processing and third-party processing fees. They have to be disclosed up front and advised up front. Okay.
Yeah, and then just in terms of how you're getting paid on that borrower paid, if your LPC or lender paid comp with Sierra is 1.5, you'll make 1.5 on these. If your comp was 2%, you would make 2%. But if you did have a comp plan with us up to 2.25, then you would make your full comp.
Correct. Hey guys, that's a Dodd-Frank TRID type thing. So the lender pay comp rules allow you to charge borrower paid origination that is either equal to or less than the lender pay comp that you have on file with the lender that you're doing loans with.
Okay, so these QR codes here, we kind of want to talk about. LinkedIn here is just how to join Sierra's LinkedIn so that you know everything as all eyes are on Sierra Pacific, what's happening. And then you'll start to find following your account executive, and they're really good about being on socials. Here is a lock at CalHFA loan. So we mentioned that barbaric form that we have to use with our proprietary beautiful system, and then we have this form. But this is the form here that you would use. You can also get that from your account manager, your account executive. And then this last QR code is an express loan tutorial on how to really plug that in. And so just as a really fast thing, you basically go into the system, you register a new loan. 20 seconds later, you've uploaded your MISMO and you have a loan in our system. It's very simple because you basically have a menu on the left-hand side that you're following. You have these mint green buttons that just kind of push you on to the next. And so when you're doing a CalHFA, you're really just going in there, making sure that everything came over from your origination software into Sierra's software perfectly. You're re-importing your credit and you're adding your CalHFA. It's really as simple as that. And the system is going to just go ahead and walk you in. What this video is exactly where to put that in. And so in your 1003, in the loan and property info, there's a spot that you put the bond loan as CalHFA, and you add that subsequent lien in there. This video will show you exactly how to do it. If you miss it, you can go ahead and reach out to your account executive. We are so grateful that you joined us. We are so looking forward to really the years ahead. We have an event coming out with Dave Stevens, and I really want to make sure that you guys are all on that event, because Dave Stevens, I know we've had kind of a hard year and a half, right? We had this huge uplifting couple of years, and then we're in these last years with 2022 and 23. But what Dave is going to really bring you is not the emotion of what we're feeling right now, but the stats of what's to come. And you guys, we are on the doorstep of millions and millions of first-time homebuyers coming into the market. So being able to know how to do CalHFA loans as well as first-time homebuyer loans, it's something that Sierra specializes in. But you being a specialist in this as well is also going to benefit you, because we have your current clientele, and we have all these people that are coming into first-time home buyership here in California and across the nation. Chad, do you have anything else you want to share while we close?
Absolutely, guys. And so, that Dave Stevens event, talks about, the upcoming wave of first-time home buyers.
Yeah.
It's real important, guys, to work with a team that understands and knows these products and is dedicated to them. So, our team, our underwriters, our account executives, every single one of you that are on this call, from Sierra Pacific, as well as the loan officers and agents, if you've worked with Sierra Pacific, you understand our acumen. We are intent on your applicant getting their transaction approved and closed and funded. And so with that, work with us, guys. Work with a lender that is dedicated for the down payment assistance programs and dedicated for your standard conventional transactions and FHA and VA transactions. Our underwriting team and how Sierra Pacific works, I'll put us up against anybody in the nation. I really will. So really proud to be part of this team. You all have account executives that are the best in the nation, that are the most resourceful, that are the smartest, that really strive for your success.
Yeah.
And so all these things, Sierra Pacific is relevant. We're here, and keep following us.
I mean, just being able to talk to an underwriter, right? Have their phone number, have them call you, you can call them. That's the same underwriter throughout the whole transaction. It's just a huge difference with Sierra Pacific. And we're going to go ahead and continue out the Q&A as we end this transaction. So if you had any questions that were not answered in there, shoot them over to your AE. They'll be happy to help. And again, we're looking forward to the years to come, and we appreciate our partnership, and we're grateful for you.
And guys, this has been recorded, and I think Friday we'll be sending out a link so that you can pull this down and share it with your peers and colleagues. And again, contact your account executive. Okay.
Yeah. Thank you, Chad, for joining me on this. You guys have a great day. Bye-bye.
Thanks, everyone.